You want to be a principal. You want to act on your own account. The energy you put out into the world is the energy you get back. But at some level, we were also changing the engines while the airplane was in the air. Fools rush in where angels fear to tread has always been my personal motto. The 0 to 1 is the only true alpha that exists in the financial markets.
At Context Ventures, our podcast at Advancing VC covers all things startup and venture capital, primarily how startups and venture capital are changing. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm pleased to invite and host Chris Douvos of Ahoy Capital. Chris, thanks for joining us.
Always a pleasure. And this is actually the first podcast I've ever recorded live in front of a studio audience, which makes me actually I had butterflies for a second, but then I was like, my kids always call me bootleg Jimmy Fallon. And I don't think that that's like a compliment. So I don't know, hopefully when the applause sign says applause, you guys will applaud too.
There we go. Chris, can you talk about your origins and especially like how you got into venture?
Sure. So I'll tell you, my journey to venture was a little bit random. I always loved the idea of startups. Actually, I'll tell you a crazy story. So it was 1999 and everybody was going into startups. This is the dot-com boom. And I was at a strategy consulting firm in Boston, as every, kind of monitor company, every, kept, 25-year-old was at a consulting firm in those days. And everybody started going to startups. And I got invited to join the startup. I interviewed a couple of times. And it was a company that was run by, or had been seeded by David Fialco of General Catalyst, and Joel Cutler. So before GC existed, those guys were doing individual deals, had some fantastic success. And I was telling Fialco that I couldn't join this company because I wanted to go to business school instead, because I didn't know what was going on in the economy. It was like up was down, down was up. Everything was just like, it was like the biggest bubble of all bubbles. And Fialco just goes, Dude, you're going to business school now? It's like studying geology during the gold rush. Dude, you're gonna be behind a desk while all your friends get rich. You're gonna be taking exams while they're in the Côte d'Azur. Like, what's the matter with you? And if you see Fialco, he had this really wild hair in those days, and he was like he's always been a wild man. The energy is impeccable. And so I was like, wow, this is crazy. I'm saying, no, I went to business school. The dot-com bust came, 9 months later, and so all these people were supposed to be on the Côte d'Azur. Saw all their kind of paper profits incinerated, which is too bad because I want everybody to be successful and happy. But it kind of stuck in me the idea, and and I was a literature, an English major, minor in college, and we read a lot of Walt Whitman. And I love Walt Whitman because Walt Whitman embodies like the very idea of the best of, kind of America. And he talks about California in one of his poems, and he says, in California, I see the genius of the modern, the child of the real and the ideal. And I've always thought like, wow, that's amazing. He says, I see in California populous cities and the latest inventions. He's talking about this in 1853. Populous cities and the latest invention was steamers on the river and many a thrifty farm with diggings of wheat, gold, and yellow and purple grape, right? Like it's this beautiful thing. And I always thought like the idea of California is inextricably linked to the idea of America, which is inextricably, I think, linked to this idea of like a monumental shining city on a hill of, that would be a beacon for all mankind. Like I've always thought that, and it's, kind of always inspired me. And so I get to Princeton, and here's the thing. So in business school, I spent my summer at Morgan Stanley, and I'll tell the story quickly. I spent my summer at Morgan Stanley and like really just didn't love investment banking. It was kind of a miserable job. And I was talking to somebody and they said, well, what you didn't like about it, and this is something that has stuck with me since and I think about it all the time, is he said, look, you were an agent, not a principal. Right? Like you were transacting something else that's something that somebody else was telling you to transact. Instead, you want to be a principal. You want to act on your own account. And he goes, and this was Seth Alexander, who was then in the Yale Investments office. Now he's at MIT. He says, look, being in endowment management, you are as close to a principal as you'll come. You're as close to managing your own business, billion-dollar fortune as you'll ever be, because we have low liquidity needs, a single client, a long time horizon, high risk tolerance, like all these things that actually make endowments great space. And I said, well, that's great. Can you think Swenson will hire me? He said, no. Absolutely not. He said, you missed your chance when you came out of college, and he didn't like to hire folks out of business school. He wanted to kind of train and mold. But he said, Andy at Princeton is hiring. So I went down to Princeton, and Seth said to me, he goes, look, at Princeton, they love real assets. They're a great asset class for endowments because if the commodity price is bad, you leave the trees in the ground, they continue to grow, they become step function more valuable as they get harder and more mature. And so it's almost like this counter-cyclical asset class where you need patience and can tolerate the illiquidity. So it's a great asset class for endowments. So he says, when you go down there, talk about that. I talked about that, and Andy was like, you seem like a smart guy. And because I used all of Seth's prompts. And I got hired to, initially kind of be a floater, but to work on not only private equity, but also real assets, timber, oil, gas, real estate. And those who know me know that like timber, oil, gas, that's not my vibe. I have like a little different energy. And so I was like drawn to venture, but it was like such a dead time. This was like now the fall of 2001, and we were in full .com bust. Like everybody was licking their wounds. And the guy who was our venture specialist at Princeton left to go to Brown University. And they said, so who wants to do venture in the Monday meeting? And everybody knows the nose game. Like if you touch the last person to touch their nose is it. All of a sudden I look around and everybody's touching their nose. I'm like, why is that? And then Andy goes, well, Chris, you're the venture guy now. And it was absolutely amazing. Princeton is such a great platform, has such great relationships. And I was able to spend time with, during a period where nobody wanted to spend time in venture, I had a lot of time with people like Doug Leone and Henry McCants at Greylock and spent a little bit of time with the Sutter Hill guys. And it was just like learning at the, at the knee of the old masters was really formative.
Incredible. Let's fast forward to Ahoy.
Yeah.
Why Ahoy? Why that name?
The name.
It has the Chris Douvos energy.
Well, do you know how hard it is to name something? Every name is taken, and this is like the late 2010s. I didn't want to do something without a vowel, right? Like I didn't want to be like investor with no O at the end, right? Like INVSTR, which probably itself is taken. So I was really struggling, and I was trying to think of something that was meaningful. And a bunch of my investors and I, like for instance, I met a bunch of investors at a golf tournament at Laurel Valley Golf Course in Pennsylvania, and so I went and think like Laurel Partners, like and I spent like literally like days thinking about this stuff. Everything was taken, all the URLs are taken, and so finally I was lamenting to one of my investors, Tim Milanich at Case Western, who's an awesome guy, great investor, creative thinker. I was like, dude, I can't come up with a name. He goes, well, how about Ahoy? You always say Ahoy when you pick up the phone, which was a nod towards Alexander Graham Bell. And then the joke of that is that it got picked up in The Simpsons. Montgomery Burns, who was like always played, to be a relic, right? He said once when he picked up the phone, like my friend, Graham Bell used to say, ahoy, right? And so I loved it. And ahoy literally means a cheerful greeting. In Dutch, it's like, hey, what's up? And I'm like, you know what? That's the kind of energy I want to give out, because the energy you put out into the world is the energy you get back.
So you have invested in a number of emerging managers, dating back from First Round back in the day to Robbie Robson, Modern Technical Fund, who we interviewed just a few hours ago.
Oh, fun.
And so you also are, in some ways, at least Ahoy back in the day, this was 2018. Emerging manager-ish too. And so what's it like starting a new fund of funds?
It's crazy. I was really lucky. Unfortunately, we had a tragic situation where at our old firm, one of the partners passed away. We had 4 partners doing private equity. One passed away. The other was, kind of on in years and didn't want to continue in the business. So I had an opportunity to lift out the funds. And in a way, I was as lucky as one could be because we had existing funds that, quite frankly, had management fee stream, which allowed me to kind of keep the lights on. But at some level, we were also changing the engines while the airplane was in the air, right? Like this was 2018 was a hectic time. The beauty of it is, and I think this is like all of the elements that allowed me to pull this off had also supported the explosion in kind of new fund growth. So the emergence of outsourced fund administrators. Like I didn't have to build a whole team. That was really lucky. We've worked with Aduro advisors for many years, and as with any relationship, it's got its ups and downs. But I've been really lucky that they've been kind of along for the journey. Legal help, is, especially at that time, had gotten, kind of compartmentalized. And we had, we actually were lucky in that we had a conflict situation. My old firm had used Cooley. And so we actually couldn't use Cooley in case there were any they were conflicted out, which was too bad because I loved our Cooley team. But the Cooley team recommended a fantastic, lawyer at a boutique firm. So we were able to leverage those guys and get really high quality service. So all of the blocking and tackling of, when I came into this business, when everything was paper-based back in 2001, you would never have been able to do. Now you can outsource all that, and I could focus on fundraising and investing, which is the fundraising part of it is not as much fun, but the investing part of it is it's just exciting to see the energy that people bring to the craft, and hopefully we'll all make money together.
And VIA, or is it VIA or VIA?
Either or, but VIA is how they said it.
Is Ahoy VIA 2.0, would you say? Or, yeah.
It's interesting. So VIA was one of the original fund of funds. Our founder, a guy named Stathis Andrus, had run the on-balance sheet investing at American Express for many years. And actually, in some ways, was a great inspiration to me because he had invested in IVP1 back in the old days. So he and Reed Dennis were like literally, this is like the Hubble Space Telescope. Stathis was the Hubble Space Telescope of venture. And it was great to get his insight.
Arthur Rock is a Sputnik.
Yeah, that's a great, I love that. We're gonna create a whole cosmological,
the space station is Andreessen, maybe.
They're actually the Mars colony, right?
I'll stop there. Sorry.
Yeah, I love it. We could go on for days and it'd be a lot of fun, but for us. So it was great, to get Stathis' insights and talk about what took place, back in the 70s and 80s, and and then to get to know through him. I knew the younger IVP folks from Princeton days when we were IVP investors, but to hear from Reed Dennis, who is really was really a formative persona, who actually I don't think gets the credit he deserves in the broader venture world. VIA1 was formed when Amex was going through its corporate convulsions in the early 90s, and they were trying to buy Lehman Brothers and then Shearson Lehman, whatever. They wanted to create a financial supermarket, and they needed to raise money, so they sold the portfolio, and Stathis bought it as a secondary and then continued investing. And so that was what I loved, was his audacity. He was actually kind of fearless. Now, in fairness, you get to a certain point in your life, and Stathis is a smart guy, but you have different priorities. Fools rush in where angels fear to tread has always been my personal motto, and I put on the jester hat every morning. Stathis is a little bit more conservative and hidebound, and his son Jason, who passed tragically, I think kind of straddled, and I very much put on my spurs and grabbed the lasso off the nail every morning and went out kind of cowboying, and I felt really lucky because even going back to TIFF days, I always had the opportunity to invest without the fear of career risk. And that's actually something that really differentiates principals and agents. And so that's the way in which, I'd never thought about it that way, but that's the way in which Ahoy was VIA 2.0.
So when I was talking to Robbie earlier today, she identified that like first round, she builds community.
Yeah.
And she has a very much focus on engineering founders. And I've listened to a lot of your podcasts, so apologies, but would ask that, are there other funds beyond first round or Ahoy that you are like, and again, you say on other podcasts, you don't play favorites, but like other firms that you have felt a kinship to or really felt like they built it the right way?
Look, I love my managers like I love my children, all equally but differently, and they all keep me up at night for different reasons. So I will say this. I can still see my whiteboard at Princeton, and Princeton was a great time because one of the things that Andy Golden, our CIO, was a great investor, and he encouraged us to like spend time looking at the ceiling and thinking, big thoughts. And then when I got to TIFF, David Salem was, very focused on. He was like, you should read, spend 20% of your time reading, and not just investment stuff, like kind of broader stuff. Just be a citizen of the world. And I remember I was sitting there thinking at Princeton, I can see my whiteboard right now, and I wrote down two things in maybe 2002. And one was leveraging ecosystems, and the other was long idiosyncrasy and short momentum. And leveraging ecosystems is something that has stuck with me to this day. And when I think about, my own investing journey, and I think about, kind of running into first round, and Josh and I were sitting there and we kind of like grew up together, right? Like I was lucky enough to be there, kind of almost at inception. In fact, I was Rob Hayes' last interview before Josh hired him. Josh said, "Hey, there's this guy Rob who wants to join, and is he LP presentable?" And so Rob and I went out to dinner in Palo Alto in 2005 or 6, and Rob opened the San Francisco office after he got hired, right? Like and made first round a bi-coastal firm, and that had a little kind of, and actually I think at that point first round was one of the first venture firms to actually have an office in the city. And that was like 2005, 2006, well before everybody started migrating north from Sand Hill Road. And that was, so that just being present at that creation. But where I'm going with that is like Josh and I would sit around, we'd have breakfast once a month and sit around in the Conshohocken Marriott and like talk about, he had this idea like, the revolution that we had seen in content consumption, going from like a hub and spoke model to a peer-to-peer network, right? Like that was actually really interesting. He said, Josh is like probably the best fund entrepreneur who's like really put a mark on venture, because a lot of things that we think about as venture today, come from Josh's idea of, he always talked about turning venture on its head. Right. And I think a lot of that stuff is the stuff we were talking about. He said, look, we don't want to have a portfolio. We want to have a community. Right. And I thought that was, kind of really remarkable. And then first round went ahead and Josh put a lot of his own money into building ahead of growth instead of in reaction to it. And so I really loved what those guys did, and they experimented. Some things didn't work that they experimented with, but like the constant experimentation and iteration of how can we are a service provider to entrepreneurs, right? And there was a time like in the mid 2000s when GPs were walking around saying like, you, the LP, are our customer. And Rob Hayes said, you're not our customer, you're our shareholder. Our customer is the entrepreneur, right? And that focus on first rounds, part was really remarkable. And I loved Data Collective, right? Data Collective, Matt and Zach, that all started out of the data drinking group at Founders Den, right? Like it was a bunch of people who would like sit around and bounce around ideas, and then they kind of formalized it into a fund. And then, Robbie and Ross Fabini was somebody, we've backed XYZ, and Ross was somebody who I never wanted to be a top-down investor. And then in my old age, I realized I've been a top-down investor all my life. Like at Princeton, they were like, we look for best athletes. We're not thesis-driven, but like everything that I've done in my life is thesis-driven. All this leveraging ecosystems, long idiosyncrasy, short momentum, the finding Ross Fabini, which XYZ Fund 1 will be probably, knock on wood, the second best fund I've ever invested behind FRC2. And I had this thesis about Palantir. I'm like, all the best grads, CS grads out of Stanford are going to Palantir in 2008, 2009, 2010. So you know what? They're going to vest, and then they're going to come out in 12, 13, 14, 15, and I want to be there when that happens. And so I knew somebody at Palantir, and I'm like, hey, what VCs are like hanging around there? Like, well, there's a whole founders fund, kind of Lonsdale clique. But like, besides that, like, nobody really hangs around here, except there's this like weird guy, Ross Fabini. And I'm like, tell me more. And they're like, he's like, well, we thought he was a co-founder. He's always hanging out with carpets. Like, he's like always around. I'm like, who is this guy? And I like tracked him down, and I found out he was like leaving Kane, and he had gone to Kapoor, and he wanted to like raise his own fund. I'm like, I need to get to know you. It's like, you had me at hello. And so that kind of like, and that's like the frictional spark that, kind of pops up every now and again, and it ignites something.
A few things I want to double click on. First is the experimentation first round. I briefly got to meet Josh a few months ago. I was like, I get to meet finally the half.com founder. Yeah. I've sold so many CDs and books back in the early 2000s to your site. But on the experimentation first round review has turned out to be a great experimentation. It's their blog of like content for founders and VCs. It's great. Another thing you said is taking time to think. And there's this great Warren Buffett quote about like, he's just like, make sure you never are too busy to not like take the time to think. Yep. Would love to hear more about how you find GPs or teams to invest in. So you said just now you found Ross Fabini. How much comes inbound and how much is like, I need to just go find them and hit the pavement?
I think that's the reason I moved out to California. I started at Princeton's endowment. I was living in Princeton. I went to TIFF. And I was at TIFF for a couple of years before I realized I really need to get out to California because there's so much that's happening, just frictionally. And I was spending a lot of time. And then as an aside, what was sad was there'd be this stretch of all the annual meetings in the spring, or like late winter, early spring. So they all started, it was always IVP, Redpoint, and Versant kicked off the Tuesday after the Super Bowl. And we called it the New Hampshire primaries because those are like you got like immediately a feel for what was going on in venture, like what the zeitgeist was, what the vibe was. And so I would spend basically all of February, March, and half of April out here, and 5 days a week. And I'd spend more time out here because I was spending time with entrepreneurs too, because that's the primary source, right? You hear venture managers talk all day long and they're just giving you conventional wisdom that makes them look good, right? But when you talk to entrepreneurs, you get the real scoop. And that's actually how I found First Round, if I'm being honest. The guys, there was a company called Video Egg, which at the time was really hot. They became Say Media. And all three of them, two of the three were Yale guys. And I read a little bit about them in the Yale Alumni Mag. I didn't want to be introduced to entrepreneurs by GPs because then you get the like, say nice things or else. Mark Zuckerberg sleeps with the fishes, if he doesn't say something nice. But when you
in AI language, they're prompted.
Exactly. Prompting is a much nicer way to say threatened. But when you just reach out to somebody randomly, and if you can come on a Friday with a 6-pack of beer and get like a real, kind of authentic conversation. I was sitting with the Video Egg guys and I said, hey, who are your investors? And they said, well, August Capital, they've been great, Maveron. And then there are these guys, First Round, out of Philadelphia. It's Josh Koppelman and Howard Morgan. And I was like, wow, that sounds really interesting. And they've been the most helpful by far, and yada, yada. And then I looked up, they were like, literally around the corner from our TIFF office. So it was like totally serendipitous. Now, an interesting question was starting in, and this is actually the way a lot of these portfolios have been built, right? Like I once talked to David Swenson about the famous Yale endowment chief. I said, how did you guys have the conviction to go into venture in 1985? Like, wasn't it really hard? He goes, actually, it was really easy. And in terms of conviction, we knew we wanted to buy long dated way out of the money options because we wanted to exploit horizon premium. We wanted to take bets that other people, and we believed that there was, kind of alpha in creation, all these things. He had a great philosophical framework. We believed venture could be a catalytic asset class, all this stuff. But he said, in terms of the execution of it, he said it was easy because there are only like 40 venture firms. And we spec'd what we wanted. We wanted early stage, kind of tech hub, investors, and they met the 25 that met that spec. And of those 25, about 15 were credible. The other 10 were, came off as jokers and not serious or tourists or whatever. And so they invested in these 15, including, Greylock and Sequoia and others. And then they leveraged that network, right, into, they got a front row seat. So that's how they met, Benchmark. That's how they met, and so on and so forth. So I thought that, I said, if I'm going to build this network, and we invested in a bunch of great folks. It started with First Round. And then at the time, there was like a little posse. It was like First Round and, Mike Maples and oh my gosh, who else was in that posse? There were like 4 or 5 guys. They were like
DCVC?
They came a little bit later,
okay.
But like this is like mid 2000s. It was like those guys, and then on the other side, there was this little group of people that kind of clicked up together, and it was like Clavier, and I think Aiden Senka was kind of in that deal sharing crew, and Dave McClure, and all of them did well. It was a real lesson in being in the right place at the right time, right? That's what was really, there are a lot of takeaways, but I wasn't actually very good or very smart for finding First Round, right? Like that happened to be me in the right place at the right time. And it was because I was early in the space, but I'd rather be lucky than good. But First Round led me to Maples. Maples led me to, I think Maples led me to Roger Ehrenberg in New York at IA, right? And so that 2005 to 2010, I could be a bad investor the rest of my life, but because of the way IRR works, like the fund that First Round was in, that's a 45x fund that First Round did, right? If not a little bit more. And then in the next fund where I raised a dedicated small fund, it was kind of a 7, it's now 5.5x distributed. It was at one point above 7. I think it's high 6s now, TVPI, but 5.5 distributed, as a fund of funds with several constituents, right? It's kind of wild, how important it was to really kind of pull on strings, right? Now, I will tell you, in the 2010s, I really got concerned with the fact that I have 4 strikes. I'm stale, male, pale, and Yale, right? I'm an old white elitist guy, right? Even though I'm not really elitist because my dad was a cab driver, my mom was a maid, all that, yada, yada. But that said, I've been very lucky and very privileged in my life. And I was like, how do I expand the circle, and how do I meet people? And actually, First Round in their partner hiring has done a fantastic job with this.
Mecca's coming on our podcast in about a month or 2.
Dude, Mecca is the bomb. I love that guy. Outstanding human being, outstanding investor, outstanding operator. But the way they have found their most recent couple of partners is they basically said, we don't want to start with our network, right? And I don't actually remember how. I want to say that Mecca came to them through a headhunter, but I don't know if that's it, because I have such a negative bias about headhunter hires because it just doesn't seem organic and authentic. But actually now I see the genius of it is because you're not replicating. We all know several very prominent venture firms where it's 5 of the same dude, right? We were all sales dudes at, Oracle, Cisco, whatever. That's more of a 90s O's template, but we know those firms where it's all just replicants. And I think First Round has done a great, I always say one of my favorite things is, every great partnership is a well-rounded whole that's made up of jagged pieces that fit together. And I think, not to fanboy, but I think First Round has done, an amazing job in that regard. And so I started going out. I started going like Equity Conference, Bridge. There's a bunch of different things that are trying to get more exposure to underrepresented minorities and females. The problem is that like coincided with a real waning of my interest in doing emerging funds, because by 2017, like I was like, there's just chaos. Like there's too many funds. There's been this.
You said there's 40 funds when you started. There's easily 1,500, if not 2,500.
Yeah, I mean Samir Kaji said there were 4,000 funds at one point, right?
I believe it.
And you could stretch the definition of a fund, whatever the number is, it's a lot, right? And so that started to really stress me out. And so I did like Sunil Nagaraj Ubiquity Fund.
Early and nerdy, like software beyond the screen. Like I have this whole thesis, which I could talk about and bore you with, about like how we're starting to see the full fruition of Tim Berners-Lee's vision for Web 3.0. And there's the data layer, the compute layer, and the interaction layer. And man, like Sunil's my archetype for the like all that human computer interaction. How do you get kind of sensors and interaction modalities that not only analyze but can predict with the use of AI, right? Like it's beautiful. Like we live in a wondrous time. It keeps me young. But after we did Sunil, like then we hit 2018, and I was like, I'm meeting a lot of people, but everybody was like in the same 6 deals in San Francisco. Everybody's like pimping their AngelList track record. And I wrote this blog post called Syndrome. So if anybody knows the movie The Incredibles, the bad guy is Syndrome, right? And Syndrome wants to give everybody superpowers because he says when everybody is super, nobody will be. And I kind of started feeling that. I'm like, every friggin' deck that comes across my desk, like I for a 2-month period, I tracked every deck, and the median IRR was 35, right? %. And I'm like, this is just like Wobegon days. Everyone's tall, strong.
Exactly. It's total like Wobegon, 100%. So I was actually meeting a lot of interesting people who were outside my network, but like I didn't actually feel like a lot of them were doing it for the right reasons. And I was like, wow, you should just actually go back to building, because I think you're really good at building. Why do you want to be a venture manager? Like this is actually a really hard business. It's a really hard business. Like people think it's easy. It's really, really hard. I want so badly to ask blank, because there's somebody very specific that is in my head who is like, this fund's gonna be a 10x fund, and now like their companies are sucking wind and haven't made the AI leap, and they're a great person, really smart individual, but holy smokes, like the liquidity is just not gonna be there, right? It's a hard business. And the marginal dollar sets the price. So, current pricing has gone crazy, and, all this stuff. You can't eat IRR. There's a whole like tag cloud in my head of all this stuff that just drives me batty. But boy, when I started pivoting back to emerging managers in kind of 2022, 2023, when I felt like the tourists were leaving, I met Robbie through some friends. So ironically, I was leveraging somebody else's work, because actually the first person I heard about Robbie from was Phil Black at True. And Phil and John Callahan, his partner, and the rest of the True team have been really aggressive about opening, widening the tent out. And I think that's great. And then I met Robbie, and I'm like, oh my gosh, like you had me at hello. And so I love Robbie. I met Kate McAndrew from Baukunst at Equity Summit, and I'm really excited about getting to know Kate. Right, there's a lot of great folks out there who are doing stuff now, and I think the pendulum is finally swinging back to making it more interesting.
So many things I want to double click on. First is you say how LPs want to meet founders. At AGMs, it's always the GPs trot the founders out. But GPs, we want to meet the customers. It's always like 2 layers down.
Right.
And then the other one is how you've gotten to know other great venture firms through venture firms. And the same is the case for GPs. Like we meet other great founders through our great founders. Right. And then on experimentation, to triple click, I guess, another thing I really liked what First Round used to do is their holiday videos. I wish they would do that again. Some really funny ones. And then on a traditional or atypical paths, Robbie, I believe, got headhunted into Norwest. And then obviously there's Mike Moritz. He's not your typical VC background. All right, and then we get more on topic, and that is, it feels that whether it's luck or timing, you said it's better to be lucky than good. You've come into the venture space, especially emerging managers, at times when the tourists are leaving.
Yeah.
I mean, whether it's first round or now with Modern Technical Fund, would you say that's by design or by coincidence?
Yeah, it's totally by design. I grew up at Princeton hanging out with some great value investors. And it's weird to be a value investor in venture. And in fact, I had a big hypothesis. Another fund that I backed that I don't talk about too much because it was 100 years ago, but Madrona up in Seattle. And I've loved
Amazon.
Yeah. So it was interesting because
you can hang your hat on that for the rest of your life.
You could. But it was interesting because Tom Alberg, the founder of the firm, what a gentleman, right? Like he passed a couple of years ago. What a gentleman. He backed Amazon and did really well, obviously. But by 2002, Madrona was, they were raising Fund 3 and they were really struggling. And I met them at Princeton, and I was really intrigued. But then left Princeton and went to TIFF, and they were still raising. Like their Fund 3 was like a real slog. And we ended up writing a pretty big check out of our 2005 fund. And that fund performed, kind of remarkably well, like 7X fund. And those guys are great people. Matt McElwain is a great, unheralded, I think, investor of his era.
They're a linchpin in the Seattle ecosystem.
Real linchpin, right? And I was talking to Swenson about it. And I was like, dude, I love Seattle. Here's what I love. There's this great density of tech talent. Input costs are lower because it's cheaper to hire an engineer. Like it's cheaper to get space. It's cheaper. He says, stop. You are playing a value hand in a growth game. He's like, you're at the poker table playing a growth game. Don't play a value hand. And that like made me really second guess myself. And but I had a real conviction about those guys. But particularly, it was like almost like we're making a value ecosystem bet, and those guys had a real value. Like Matt McElwain, like I think came up through, investment banking or asset management, but he would articulate like a value orientation, which, kind of allowed him to invest in some, companies that have become outstanding, important companies, right? But not the kind of momentum go. And I've come to really, for a while, I was like stressed about them. And then they made a lot of money, made me look good. But there was a while where I was like a little bit like, oh, would I have done that again? And man, looking back, I would have told my young self to do it, 10 times out of 10, because it was the right bet at the right time. And look, you could debate about Seattle as an ecosystem, but there are going to be great companies that come out of there. And I do think the world is, flatter. Like that's a whole, different discussion. But I'll tell you that going back to something I said earlier and that you kind of alluded to is, as an LP, it's really hard to meet entrepreneurs. Like, especially if you're, there are a lot of people, look, I run a fund of funds. I'm an intermediary. Great. I get that, right? But I meet a lot of people who are like flying out here from, Baton Rouge or wherever. Not that Baton Rouge is not a fantastic, and there's some very smart people. And I said that because I don't know anybody. I don't know a soul from Baton Rouge, so I'm not pointing at anybody. So nobody will get butthurt. But people are flying out here.
You can say Tallahassee. That's where I'm from.
There we go. Okay. But there's some good investors in Tallahassee.
There are.
And there are probably some in Baton Rouge. I just don't know. And if they fly out here once a quarter, or even that, they're just getting like cosplay, right? It's just cosplay. And so that's why I moved out here. I was saying before, I was spending so much time out here that my daughter said to me, I was going to miss a play of hers. And she said, that's okay. I know you're my weekend dad. And that like broke my heart. And that's when I decided to move out. That plus the fact that I felt like you needed to be in the ecosystem. And I was lucky. I knew some entrepreneurs in Seattle. Like Chris Douvos was a couple of years ahead of me in college. And I got to know, him and Sam Herring, who ran a couple of, some great, smart folks. And they're like, oh yeah, these guys are the bomb, right? Like, it was, and it was lucky. I've just been really lucky in that regard. But and I've been privileged and all that stuff, but like building those relationships is hard, but really important. Because it's like I have to use my liberal arts education to the fullest because all my friends used to make fun of me for it. But like it's like Aristotle's kind of the Plato's allegory of the cave as recounted by Aristotle. Like people are sitting in the cave like looking at shadows on the walls, and they think that those are the actual forms, but the forms are outside in the full sun, right? And when you get here, when you get to any like big tech hub, you realize like holy smokes, there's all this stuff going on that if you're not understanding it at a visceral level, you're really missing something. Now, just to be fair, I also think that there's a real monoculture here, right? Like, and I think people need to stick their head out of the monoculture and understand consumers and end markets and the geopolitical world and the micro political dynamics and all this stuff. Like, there's a whole big world, but man, in terms of like building, there's nowhere that's as fertile as here in San Francisco and the Bay Area more broadly. I think there's some important stuff going on in Boston and New York and LA, but man, it is, from the gold rushers to the dust bowlers to the dot-commers to the AI folks, the Bay Area keeps reinventing itself in ways that are inspiring and wondrous.
I want to double click on a few things you said there. First is the gold rush. There's Levi Strauss is still around from the gold rush, right? And interestingly enough, the gold rushers aren't, but the folks who provided the shovels are.
Right.
The other thing is around value and growth. I think oftentimes about Munger and Buffett, and Buffett started out as purely value, and Munger came in and said, you got to pay up for good growth. And I struggle with that as a GP sometimes, like, hey, like I think it's this valuation, but am I going to miss it? And so there's that tension, and it feels like you also have that tension too. The question I have is around the future of venture. So you had mentioned Yale and Swenson, and right now they're in the news because Yale and Harvard are selling secondaries, who knows at what discounts. And then there's also this explosion of AI. Where's venture for you, or where do you think it's going a year, 2, 3 years out? Not 5, but...
Which, by the way, you mentioned Buffett and Munger. I'll tell you, one of the firms, and I'll name check these guys, one of the firms that I think doesn't get the credit it deserves, but if I could like literally rewind time, there's a few firms that I would like bang on the door again, but one firm that I would knock the door down, and it was right there. Like I spent a lot of time with them, is Altos. Those guys have done a fantastic job, and it's very rooted in their understanding of Buffett and principles of investing. Those guys are really outstanding, a little bit under the radar for people outside the business, but man, they've absolutely crushed it.
Oh, there's so much to say about Altos. I have a tremendous respect for them.
Yeah.
They early on called them cockroaches. They're going to survive no matter what.
Yep.
And then like their lineage of Buffett, by the way, was Warren Buffett, this professor named Jack McDonald at Stanford GSB, who taught about value investing.
Yep.
He helped him actually stand up Altos when other people didn't understand. An Army vet. I had the good fortunate to take some of his classes. So. Yep. That's in your, as best would call it, anti-portfolio.
Yeah.
Actually, when we're on that, any other anti-portfolios?
Who I really liked, and I just didn't end up pulling the trigger, and I don't remember why, but I think they're outstanding folks, and they hit a lot of the things I was focused on in terms of leveraging an ecosystem, et cetera. It was Pear. I think those guys are fantastic. I think Mar is great. I think Pejman is great. Like they've really done, kind of a fantastic job there. That's another one that's in the anti-portfolio.
Both are immigrant mentalities.
Look,
Altos and Pear.
My parents were immigrants. Immigrants who get the job done, right? Like I think, and Sequoia really believes in immigrant founders, right? Like I think there's an immense amount of energy and kind of chip on shoulder, right? There are other firms in my anti-portfolio, but those are the two I think that kind of stand out.
You were going to talk about Buffett, Munger, something, I think.
That
was Altos.
Altos, yeah.
Check. So venture outlook.
Yeah. So look, my crystal ball's still in the shop. I think that a lot of people are stressed out right now because liquidity has been really weak for some time. perhaps we get some liquidity later this year. I thought 2025 was going to be a good year, but then we had all the uncertainty, and that really scared people off. But what's interesting is a lot of people are panicking, and a lot of LPs I talk to are, kind of dismayed. But I'm like, no, this is venture, right? We have 60,000 venture-backed companies. That's too many, right? Like, 1,000 companies plus or minus, it's like actually like literally like 1,000 with a standard deviation of like 200 get acquired every year. And then, in a good year, you have, 50 to 100, IPOs in a great year. So the net absorption, as to use a real estate term, is so low. It would take, 30 years, 35 years to absorb all these companies. Meanwhile, we're still making a bunch. And we're seeing, I think any company founded between 2020, if it doesn't have an AI transition story, it's suspect, right? And we have some companies like in our 2012 fund, like we have some companies that are not making the transition successfully, but then we have like I used to lose a lot of sleep about Notion because it's so highly valued and it's such a big part of our 2012 fund. But Notion has done a fantastic job, right? So, it's like, that's the essence of venture. And it's like, yeah, sure, there's power law, there's all that stuff. But ultimately it's like in any one of my funds where we'll have like 400 companies on a look-through basis in my fund, 10 will matter. 10 will really move the needle. The next 30 will have some impact, but then the rest will just be, fodder.
Power law is very real.
So that was a long story saying that there are a lot of LPs who are going to be really disappointed. And I think a lot of LPs are going to really struggle with where to go in the asset class. And so I think we're going to continue to have caution. I think that's, and we're going to continue to see a consolidation of dollars in a handful of funds. And I heard Mark Andreessen talking about this at a little talk not long ago, and I've actually been thinking about this for a while. And you alluded to the fact I was at Monitor Company a long time ago. Michael Porter was one of the founders, and the strategy, Five Forces guy, Harvard Business School strategy guru. Another thing he talked about was when he taught in the book where he introduced Five Forces or kind of codified it, he talked about the two privileged positions, which everybody now calls the Porterian positions. Everything in consulting world is a 2x2 matrix. And on one side you have cost and on the other side you have differentiation, right? And you basically have these two clusters of successful firms when it's, these behemoths that are just driving economy of scale, but they're basically commoditized, but they're driving economies of scale. And then you have highly differentiated, kind of boutique. So if you think about the auto industry, it's, obviously the handful of giants, but then you have Aston Martin, right? Like that, right? So, and I actually think venture is going that way. And I think, and I actually had a great talk with Bill Trenchard about this at First Round, because he's also a great thinker. He's actually he's actually one of the smartest people in venture. And I think he's doing some really important stuff at First Round. And obviously we've got, A16Z and Lightspeed and Sequoia, General Catalyst, right? Like you've got this group of firms that are, I think, fundamentally in a different business, right? And then you have this...
Someone said aircraft carriers. They might be Death Stars.
Right.
They're big.
They're big, right? Like, I think that's right. That's no
They
moon.
suck in Millennium Falcons.
Yeah, exactly. That's a space. That's a space station. Yeah. And then you have a bunch of like really interesting, kind of dynamic small firms that are exciting. My worry is that, the market for those firms isn't big enough to support, 1,000, firms, right? There's a reason why I wish I knew cars. My son could tell you this, like all the like exotic, car makers that have gone, kind of bust. But there's a reason why some of these guys struggle. But then you've got in the middle, you basically got benchmark. And so I said to Trenchard, like, how, for funds that are mid-size, like how do you either grow to where you kind of can compete with the aircraft carriers, the Death Stars, or are you kind of stuck, which would be good for me, I think, because your fund size is your strategy, right? But if you're kind of in the middle there, you're kind of getting it from both sides. And Benchmark has done a remarkable job. I think First Round has moved that way as their funds have gotten a little bit bigger. But I think they do, Benchmark does it because they're just such phenomenal individuals and they have structured themselves for success. First Round does it because they do, a lot of great content marketing and platform initiatives, right? But who else does it well? And there's some that I could name firms, right? That I like, that are doing a great job. But I think, time will tell if there's room for more than 2 or 3 firms in the middle. And if that's true, then that means half of Sand Hill Road, 2/3 of Sand Hill Road, they're dead. They just don't know it yet.
In preparation for the podcast today, I was listening to Jeff Clavier get interviewed in 21 at that peak venture. And it's just so fascinating to hear just a few years from then, just nothing kind of played out. And so my take is we don't know.
We don't know.
And
right?
it'll be exciting to see. You talked about venture and startups being a heartbreak business. You've been in the business for a while. Yeah. How do you keep your heart not broken?
Oh my gosh, it's like every single day there's something new that just gives me, as we used to say in Brooklyn, agita, right? I've always got agita. But you know what? What keeps me excited is the energy, right? The energy of venture, there's a reason why everybody really wants to do it, because it's so life affirming. It's a creative act, right? And so I might get down about company X or company Y or manager A or kind of manager B, but ultimately we're backing. I always say, I have debates with people who are serious asset allocators. There's this thing called the Q Group, which is the group for quantitative research in finance, and it's all these people. You took McDowell's class, and all these people who have ratios named after them, or Sharp is there, and Trainer. I met Jack Trainer. I'm oh my God, Trainer's ratio, what's up? The one time I went from Princeton, I was so out of my depth there. It's Cliff Asness is over there, and there's a calculus cloud over his head, with equations. It's solving equations as you're sitting there, and it's wow, these people are really smart. I have no business being here. And you talk to those people about asset allocation, they give you numbers and derivatives and ratios and everything, and I'm what we do defies all that. But at the end of the day, I call bullshit. You tell me there's alpha in this asset class or that asset class, and I say no, that's just super beta, right? Everything is tied to some sort of thing that's already existing, and you're making that thing that's existing, better potentially. What we do here is Adam and God on the ceiling of the Sistine Chapel, kind of laying there with their fingers, a centimeter apart, and you can feel the spark of life going from God to Adam, and you're that is what we do. And that the 0 to 1 is the only true alpha that exists in the financial markets, but alpha can have a negative sign in front of it. So some of that stuff will blow up, on the launch pad. But man, the stuff that gets up into orbit is going to be really important and change the world and change the way in which we do business and live and interact with each other. And that's what kind of keeps me going.
So if we're going to use that analogy, Michelangelo is painting that the LPs are the Pope and the Borgias. Is that fair?
The back in the the Renaissance, there was some pretty sordid stuff that went on. I can't say anything about that, but
but the spark and we're talking about history and literature. A person that doesn't get enough, I think, visibility on his writings on venture and startups is Michael Lewis. Because he wrote 2 books on I think it's The New Thing and The Next. And it just talks about this excitement about startups and innovation.
Yeah, and like I said, for me, it's the idea of America. It's literally tied into the pioneer spirit, and we can talk about whether we're in dark days for our great experiment or not. But man, this is literally why people got on boats and braved the waves, right? And Alexis de Tocqueville in Letters from an American Farmer has this great phrase. He says, "What then is this new man?" this American, right? And he says, he's closing a circle, right? Oh my gosh, this American is an immigrant who says, ubi panis, ibi patria, where there is bread, there is my country, right? And he has this whole long eloquent thing about, people who are searching, right? And I think that's a big part. Like everybody who's here is looking for something. Right, we're trying to create something, kind of here in the Bay Area, and not everybody, obviously, but there's such an energy kind of associated with that, and that is ultimately part of the kind of American DNA.
A few things on that. One is I know you love quoting Fitzgerald, Whitman, and now Tocqueville. All of them are all students of American dynamism, for lack of a better reference. They're just like, what makes America unique, or what is the je ne sais quoi? And the other thing that's fascinating, connecting Tocqueville with First Round, with modern technical poem, with what you do, is Tocqueville loved to study how community organizations were built within America. And that he said that was very unique to America. All right, rapid fire questions.
But on that point, like, and look, that's a great way to put it. Like, I think America is dynamism, right? But I don't want to sound jingoistic. I don't want to be like a, rah-rah, kind of USA guy necessarily. I'm proud of being here, having been born here, all this stuff. But like, I think it's symbolic. Like even Ho Chi Minh during the Vietnam War would talk about the Declaration of Independence as being inspiring, right? And I believe in this idea of America that America strives to. And there's always going to be a gap between espoused values and values in action. We certainly have a lot of retrograde stuff that goes on in the country. And it comes in waves, right? Like anybody who studied the 1920s feels like this is a very familiar time. With the rise of nativism and some of the economic stuff that went on and all this stuff, like it's history doesn't necessarily repeat, but it certainly does rhyme. And these pendulums swing. But when I talk about the idea of America, I think of it as like, something that is not like jealously guarded, but rather something that can kind of, be inspiring for the world and give hope to people to build in the places where they are.
Totally. I think of America in some ways to ground it in startups. It's open source projects.
It's the greatest open source project in history.
Totally. I teach to cadets a military history course, and we talk about how George Washington inspired, fortunately, unfortunately, Lenin, Mao, Ho Chi Minh, all these other folks. Yeah. Rapid fire questions to close us out. And this one is a difficult rapid fire question. Ooh. How many companies should a fund invest in?
Oh my gosh. I'll give you the answer. I have a definitive answer. Okay. The number of companies should be completely consistent with your strategy. Right?
Fair.
Strategy is a set of informed choices that inform timely action. Right? Like that's the Mike Porter definition. So if you have a high touch strategy, it should be fewer companies. If you have a low touch strategy, it can be more companies.
Favorite movies?
Oh my gosh, that is really tough. I gotta say, this movie is actually really important to me because I was 17 years old when it came out, and I lived a half mile from where it was supposedly taking place. Do the Right Thing by Spike Lee.
Fascinating.
Yeah.
Just because you mention all these authors all the time, I'm curious, any other movies besides Spike Lee's Do the Right Thing?
Oh my gosh, I have so many favorite movies. What would
Malcolm X or X? That's another Spike Lee movie.
Yeah. I mean,
you mentioned Godfather earlier.
Yeah. Oh my gosh, I'm gonna noodle on this as we talk, and then I'm just gonna blurt it out when it comes to me.
Great.
But I will tell you, do you know what a movie that not a lot of people like that I absolutely love is the most recent Great Gatsby. A lot of people thought it was over the top, and I'm like, it was over the top because it was the 20s. It is the definitive novel of the Jazz Age. So how do you capture the Jazz Age without being completely over the top? People are like, Baz Luhrmann is kind of ridiculous. I'm like, no, it was perfect.
Leo did a better job than Redford, and yes, and it makes great memes.
Carey Mulligan, man.
Favorite snacks?
Oh my gosh, this goes way back. When I was a kid, my dad walked in on me, and like recoiled in horror when he saw me sitting in the bathroom with a tub of Cool Whip and a box of Nilla wafers, like eating. And I literally took down the entire tub of Cool Whip with kind of Nilla wafer medium. I mean, that was probably a 2,000 calorie snack.
Nilla wafers are great. When I think of Nilla wafers, I just think of Nabisco, that branding on the side, that corner.
Yeah.
Favorite travel spots? You mentioned Côte d'Azur, I think.
Domestically or
domestically. So you don't come across pompous.
Yeah. Well, I mean, I don't travel that much internationally. I do say my dad is from Greece, and so I've been lucky to go to Greece a few times. The islands are amazing, and the vibes are immaculate. People are super friendly. I was just in Ireland. I tacked on a long weekend in Dublin with my partner. She and I went up after I had a work trip to London. Dublin was amazing. The most amazing people. I'll tell you, I really enjoy. I'm a big golf guy, so I enjoy golf destinations. I want my ashes to be scattered at Bandon Dunes in Oregon. But I'll tell you, if I'm going for like a trip to a city, Seattle is an immaculate place. I grew up in New York. I love New York, but Boston. I lived in Boston, great cities. We've got an embarrassment of riches of great place to visit. Man, Seattle is an absolutely amazing. It's very idiosyncratic.
I've spent a lot of time in Seattle. First place I was stationed. Seattle in the summer is unbeatable. The other 8 months out of the year,
it's tough.
Contested, debatable.
Yep.
Chris, thank you so very much for taking the time to
This
chat.
has been so fantastic. This has been outstanding.
Do you have 5-10 minutes?
I do.
2/3 of Sand Hill Road venture companies are dead. They just don't know it. Can you elaborate a little bit? What's going to save them, or what's going to be their demise?
And for clarity, these were 2/3 of Sand Hill Road venture firms, right? And we use Sand Hill Road metaphorically. It's not specifically those firms, but it's like what I mean is like traditional venture firms. And what I'd say about that is, I think that we're entering a period of LP fatigue ahead. And I think a lot of people who've been kind of historically blindly re-upping in funds because there's just enough hope. And I always say, people feel about venture the way they feel about Congress. People always say they hate Congress but love their congressperson, right? And people hate venture but love their venture firm. But I think the proof of the pudding is in the tasting, and people are going to start saying like, show me. Now, what's going to help people survive is like, man, the number of firms that I know who have raised 3 more funds because they were in the one hot deal is like mind-boggling to me. Like LPs and I sit around there like, can you believe Fund X is still around? Well, it's because they were in the C round of whatever, right? Like it's literally like they did the C round of Uber, so that like kind of, and then like if you're around long enough, like something can happen that makes like I'll name names. Firm like that's done a great turnaround is KP. Right, like, and another one is, and I'll name names because I think they've done a remarkable job, and it's all because of Venki, is Menlo. Like that was a firm that was kind of like gasping for air, and then boom is like in the thick of it right now. So there are firms that like can kind of right the ship, but I think there are a lot of firms that are just that unless they get lucky are going to start facing some really hard questions. Now, having said all that, I'll talk out of both sides of my mouth. There always seems to be like another pool of capital, right? Like, and I'm like, when I started, it was, in 2000, it was like all these like tech billionaires were, first it was the insurance companies in the 70s and the endowments in the 90s. And, and then at one point it was Australian, super funds. And then it was the oligarchs and then, the Gulf. And it's like, where's the next pile of money? Oh my gosh, South American pensions, that's next. Or Baltic high net worths. Like literally the things that like these waves of capital come in and allow people to survive, which I think is great.
Yeah, so you mentioned the Altos as one of your favorite funds. I was kind of curious because they're very low radar. They don't get recognized on the Midas list. So like I imagine it's actually very hard for non-Koreans to actually come across them. So what kind of gave you like conviction with that much signal here? And what makes them kind of stand out compared to other funds?
So, and I've known those guys, I've known them as a firm since like 2002. And I've known, like Anthony Lee's wife worked across the hall from me at Monitor Company. And so I met him like for the first time in the early 90s or mid 90s. And so I got to know them when I was at Princeton because I loved how thoughtfully they constructed their portfolio. Like they were investing grown-ups, right? And all three of those guys, and then Han went to Korea where he did a bunch of great deals. And that actually like came later. They were just like toiling away, not getting a lot of recognition. I was like, wow, these guys are onto something. And then obviously what's gone on in Korea has been really fantastic. I think he's been like a catalyst of what's, some of the good stuff that's gone on there. And then and then Ho over here and Anthony just, they were like Roblox. They were in Roblox, which is such a great exemplar of their process because they were very, very high conviction, very ownership oriented, and very patient capital. I guess that's where the part of the intersection of Buffett is. And they talk about cockroaches, they talk about hedgehogs. They have all this great writing from the mid-late 2000s where I'm just like, wow, these guys really are thoughtful. And they stuck with Roblox and bought up in Roblox. And Roblox turned into like a 10-year overnight success story. First round was in Roblox too. And like, there were a lot of times where I'm like, wow, this, like when Microsoft bought Minecraft, I was like, oh, Roblox is dead. Like we missed our window. But man, the metrics, and that was another thing that the Altos guys like stuck with was just the metrics of it there's something to believe in. And Buffett always has opportunity equals value minus perception, right? And value being intrinsic value, like value with a capital V. And part of the problem is with Silicon Valley is sometimes perception and value have a recursive loop that create this perception of value. But ultimately, at some point, the opportunity is somebody has to pay you for value that you've created. And the best time to get in is when that perception is low, because then it's this pivot around value. So the opportunity is high. And those guys really understand that.
I love the literature in the history class. So my question is, what's your most life-affirming investment? Like, I love that word, and we're doing something life-affirming too, but what's your most life-affirming investment?
There's so many different ways to come at that question because there's even being literal about it. Like we've invested in healthcare companies that have, kind of expanded quality of life years. But ultimately, I think everything we do comes down to human contentedness, right? Like how can we improve human contentedness? And so right now, my favorite company is a company called Loyal. And I think the website is now Loyal. For a while, it was Loyal for Dogs. And what they're doing is life extension for dogs. And so Celine Haliwa, the founder there, is a biotech PhD, and she found some old drugs that could be repurposed, and they're going through the FDA process, and they're, knock on wood, hopefully going to get approved. First round back those guys along with a bunch of other folks. And you know what? Every time you talk to somebody about their older dog, they dread the dog's passing. It's like their kids grew up with the dog. Dogs are such a part of our lives.
Phenomenal. Such a nice time lapse. Nuggets, like so many, it's hard to double click. But a couple of things I particularly want to highlight is, if you were to be contrarian today, what would you go against the gravity? Where do you think the gravity is going? And second, again, whether it could be technology or the type of founder or the round, we used to think like early is better. Second, most companies are getting to revenue faster, particularly in the AI world, means they don't need further funding, or that's the understanding by some of the founders. So what does it mean to be not just a VC, but an LP in a VC fund, double paying the management fee and so on and so forth?
The first question I think was about like, where would I lean against gravity? And I feel like what's crazy is there's such an aggressively dynamic flow of capital. The gravity is everywhere. It's impossible to be contrarian because there's capital that's oriented around being contrarian that then, I used to do I still do a lot of investing in deep tech. And, the joke was in like the late 2010s that the time it takes to go from, kind of frontier to conventional is like, gone from years to weeks, right? And so like you look at somebody like Lux Capital that does a great job of being out on the frontier. They feel like when I first invested in Lux, I used to co-office with those guys, all that stuff. Like you'd be like, wow, this is crazy stuff. And today it's like, yeah, somebody else is going to, do this. The world is full of fast followers. So the short answer is, I don't know. Where we are spending a lot of our time is our portfolio right now is going to be about half and half, which is going to be about half what I'd call like people like Robbie, so classic Silicon Valley, finding the new thing, who leverage community or build community, and the second half is what I would call AI-enabled micro buy and build, right? So this is like Bain Capital Ventures, proto BCV back in 2002, except they had business process outsourcing. Now we have AI, where you can you can slap AI on some dusty industries, turn them into cash flow champions, and then either grow those companies and sell them organically or turn them into, kind of acquisition champions to do roll-ups. And that was really clever and offbeat in 2023. And now Elad Gil is doing it. And I felt like, and we've backed a couple of great managers, Asymmetric out of Boston and New York, and Story Ventures that I'm really super excited about. But even in the time since we've backed them, the space has gotten like so much more crowded. And I'm like, wow, this is wild, right? The second question you had is like, and I get it, like you can go from, Josh Koppelman always talked about when I first met him, he said, going from, he built 3 companies, Infonautics, Half.com, and then Turntide. And with each company, there was an order of magnitude reduction in the amount of dollars it took to get to first revenue from 7 million to 700, no, from 70 million. No, maybe it was 7 to 700 to 70, right? Whatever it was. But that was today, Josh says that, the cost to get a company to first revenue is the opportunity cost of your time, basically, right? With an AWS account and a credit card, you can get to first revenue like that. And then revenue is the ultimate, like non-dilutive, financing. And so, and with AI, we see these huge ramps. And somebody said something to me, which I love. They said it's never been faster to get from 0 to 100 million in revenue, but it's also probably going to be just as fast to go from 100 to 0, right? And I think Jason Lemkin said something interesting. He says, everybody thinks we're going to have 1 million. We're going to have one firm go to $1 billion in revenue, whatever. Or maybe we'll have 1 billion firms go to 1 million in revenue. Right? Like, we don't know how this is going to play out yet. And I'll tell you, one of the things I've been most wrong about, and I'm sorry for the long answer, I apologize. One of the things I was most wrong about in my career is I leaned in hard to the micro VC revolution in 05, 06, because I thought the economics of venture were completely broken and that they would completely make extinct all of the Sand Hill Road firms, because the cost, that Koppelman dynamic of orders of magnitude to first revenue, that was going to be the only dynamic. And all of a sudden, you're going to be able to like build these companies that would never need capital again, kind of like what you said. But then Fred Wilson wrote this great blog post. He goes, yeah, that's all true, but barriers to entry collapsed. So then maybe you need $1 billion. And this is where we got to the whole weaponized balance sheet era, right? Where all of a sudden you needed $1 billion, or not $1 billion, but like hundreds of millions of dollars to just get customer attention. Right? Like, and marketing, go to market. So like, that's actually one of the reasons why I love Robbie, is she's really good GTM focused. And I think ultimately, even though it's going to be really cheap to get these companies off the ground, GTM is going to, separate the quick from the dead.
Thank you. Great presentation. Wondering if we were to think about the macro reason behind investing into funds. For you, I'm curious, and we talked a little bit about VC being this like opportunity to pioneer or like to create. I'm curious, from your personal perspective, are you seeing investing, do you invest more in companies or in funds that kind of like have a specific vision for the world that is aligned with yours? Or do you invest in funds more that might have vision for the world that is interesting, but not necessarily aligned with yours, but you see that could be the future going forward? Or is there any other macro reasons behind you investing?
I've never been asked that question before, and it actually reminds me of a piece of advice that somebody gave me before business school when I was doing public market investing. And they said, a great analyst has no ego. And I've thought a lot about that in my life. And sometimes have invested in funds that are hedges against my own potential stupidity. And so I have a really good example, but I don't want to talk about it because it would make me feel really stupid about myself, because there's something I really, really didn't like that I've been completely wrong about. And I'm still like processing it emotionally. But I invested in a fund that's like a derivative play of that. And actually, like one thing that I invested in a crypto fund as, this is not what I was talking about. The other thing is different. But I invested in a crypto fund because I hated crypto funds, right? And I have this real belief that crypto is overhyped in the short term and underhyped in the long term. But we invested in a group because I was like, you know what? I have to have at least a bet on in case I'm completely wrong. And I literally, like, as I was filling out the paperwork on this thing, signing the docs, I was like, you know what? A great analyst has no ego. And I hope I'm right in the macro and that these guys somehow figure out a way to make money. But it's wrong. It's hard. Like, I run a really idiosyncratic portfolio. We're really short momentum, right? And so there's a lot of things that, like, the ultimate thing I could do actually to hedge against my own ego is to invest in like one of these aircraft carrier funds. I think they're doing venture completely wrong, but that's my opinion. And you know what? That assertion was wrong for all of the 2010s. For the whole ZERP era, I was wrong. Now, we did well enough because we were able to, like, our manager selection was really good, and a lot of our managers obviously benefit from the presence of those later stage funds. But that would be the second you see me invest in third quartile partners that is raising an $8 billion fund. That's when you can tell me to, like.
I'm curious if I may ask a follow-up question. Do you think investors like general partners should also think the same way? Like, analyst does not have an ego. That's very interesting, because if you think about it, GPs probably should be betting on kind of like the frame of the world that they think we're moving towards, to, right? Kind of like bet and enable that future. Versus, I wonder if you think this also implies not only to LPs, right, or fund of funds, like, or GPs as well.
That's a really important question, in that what I think ego is important, right? Because I think you have a set of skills and experiences and opinions about the world. Because ultimately, like, we're investing in people's, behavioral footprint and their opinions, and you want those. But what you want is the humility. That's where I guess I maybe differentiate it, is you want the humility so that people are constantly reassessing their worldviews rather than their worldviews becoming ossified. Now, you may have because I will, again, I speak out of both sides of my mouth. It's my poetic license. Literally, my mantra for my fund is, give me a robust nonconformist that has the courage of their convictions, right? And the courage of their convictions, you could take at some level as ego. But really what I want them to have the courage of their well-formed convictions that are constantly being retested. There's a fine line. There's a fine line between having, actually, this is the last thing I'll say, and I can get literate one more time. Any chance I have to get literate, I feel like I'm amortizing the cost. If you think about a Greek tragedy, there's something called the Greek tragic cycle, which goes K-H-A-N. Oh no, K-A-H-N. So it's kata, which I think means the deed, like you did something good, you did the heroic act, right? And then you have ate, which is the recognition that you get from having done the good deed. I think I've got this right. Then you have hubris, which is when you have the pride from that. And then you have nemesis, where the gods get angry at you for being too proud. And so it's like, where do you stop? Where does your ego stop? And I haven't done this metaphor in so long that I think I've got it wrong. I think it's ate, and I think hubris is actually a constructive thing in Greek. Like hubris is like the ego that I think about. But I'll have to look it up, and I've completely failed at my metaphor.
Good. I'm thinking about Euripides right now, and then our movie. I'm looking forward to Christopher Nolan's Odyssey.
Oh, it's going to be fantastic, right? Like my home network.
Greece too.
Yeah. Oh, my home network is Telemachus, which is Odysseus' son, and then of course my office network is Sisyphus, because all we do is push the rock up the hill all day long, only to get flattened.
Everyone, let's thank Chris.
Thank you, guys.